Hi, folks. This is Sean Hyman from the Logical Investor newsletter, and you can find out more about what we do here at SeanHyman.com. So that's SeanHyman, SeanHyman.com. And whether you're a subscriber or not, there's 2 or 3 tabs where you can on the site where you can gain free information, and one tab that is just for subscribers only for buy and sell recommendations on true investments that we hold for 2 to 4 years on average. And take a very contrarian approach. So feel free to share this on your social media accounts, Facebook, Twitter, and wherever else you like. I want to talk about the recent volatility and the levels to watch from here into some of the most recent observations. The market has fallen quite a bit, but when I say the market, I'm talking about one of the broader measures of it, the S&P 500. And the price for the first time in a long time has fallen below its 50-week moving average, with the RSI slumping over, the MACD slumping over, and a hard sell signal here. So those are a bit concerning. And you've got some areas like right here that have been broken. Now, again, could the market climb back above it temporarily? Sure, it could, but there's this trend line that's broken that has covered 2 or 3 years worth of activity. You've got the divergence on the MACD and RSI where the prices went higher, but yet the indicators went lower, and the price had been far away from its 200-week moving average, which is a big sign of over-optimism and a lot of downside risk versus upside reward. So that's one of the the big concerns that I've been warning about. And on the daily chart, you see this last sell-off that we had back in, February, where the S&P 500 went from 2872 to 2532 in seemingly a blink. That this whole area is an area of support that you would want to watch to see how the market deals with it. So you would really, it would be, and it is a region, so that's why I'm using like a rectangle here, because you've got the absolute low there, but then you've got most of the support up here at the top. But if the market were to break through that region, call it 2530 to 2600-ish, and by the way, I mean, look at all the selling that's been happening here lately, so that's a huge bad sign. Look at the what's been happening on the S&P 500. On the RSI, it's just been falling off a cliff. The MACD's been slumping for a while now, but then it goes down to lows lower than at any time in the last year, which is extremely negative. And it breaks one of the more aggressive uptrend lines as well. So you've got the price breaking below the 50-day moving average, breaking below an aggressive uptrend line. Again, not its long-term one, but an aggressive one, breaking below its 200-day moving average. And still, even with today's fall and bounce back, it's still below that moving average. These are all bad signs. And also look at the huge swings of volatility that we're seeing in here and in here. So when we've gotten up into this region, it tells you the institutional investor has gotten very, very nervous, is probably one of the best ways to say it. So they know that, S&P 500, 2800s to 2900s is just so astronomically overvalued that there's been sharp sell-offs that have happened each time we've gotten into this region. And even a lot of divergences are forming now, and a lot of heavy selling coming on board as well. So in the near term, anything can happen. In the near term, we could get a bounce, back higher. And if we get a bounce back higher, what you want to look for is, does it still stay under this aggressive trend line? And if it should go above that, does it end up going to or above, or does it go above this high here? If it doesn't go above this high here, if there's any failure and rollover, major rollover, below here, then there's a huge chance we're at the start of the downtrend. And then when the longer the price continues to hold under the 200-day moving average, of course, that's a very bearish sign. Some things that you would want to be aware of on the weekly chart. So here's the last bear market in the S&P 500. Went from 1576 to 666. So I'd call that a heck of a dive off. And the sell-off, happens in waves, in three major waves: A, B, and C. C is normally your longest, and they all unfold differently. This one transpired over probably a year and a half or more, in time. Some of them might transpire over 6 to 9 months if they're steeper and deeper. But when the downtrend starts, my point is you shouldn't be quick to jump in and go, oh, hey, there's screaming bargains, like somebody did on my Facebook today. Oh, everything's on a fire sale. Hardly. Because it would seem like things are a fire sale when they go from 1576 to let's say 1350 or 1300 over in here, right? But then when you see that the downtrend continues to 666, well, this was still very expensive looking. And if you look at average PEs like we do in the newsletter, then you would know that even a pullback from here to here is still going to be expensive on a PE basis, and there's still going to be more to go. And then also, if you follow what we do, then you know about Elliott waves, which have three major downtrending waves, and it takes time for those to transpire. So that 6 months to 2 or 3 years is how long on average that these bear markets tend to play out. So the longer you're willing to sit on your hands, typically the better you do. And then of course we have averaging in techniques that help get you lower to the bottom, because nobody's going to call the bottom. Nobody knows when the bottom is, else everybody would go in at the bottom and they would exit right at the top, and there's not a professional out there that knows that. So there are techniques that I use, that Warren Buffett uses, that helps get one's average price closer to the bottom than it would have been had they had just done how they normally trade and invest. But with that said, there's a process. The price breaks below the 50-week moving average and starts to hold there, and that 50-week starts to slump down. That's your first sign. So we're just starting to get to the very early signs of that, where the price is starting to get below the 50-week, but the 50-week hasn't rolled over yet. Then you get a bigger sign where the market goes down and sometimes might even touch the 200-week moving average, but bounces up to the 50-week moving average that is now turned downward. And that is a very huge sign that the downtrend is very likely started, because the price can't get above that downward sloping moving average. And this high here is lower than this high. And then when it goes below the 200-week moving average, it's also going into making another major lower low from here to here. And that's about all the signs you need to know that there's going to be, still quite a bit of bear market ahead of you. Even wave C typically has 5 waves within it: 1, 2, 3, 4, and then 5. So even those typically take a bit to play out. So, and then, one day when the price gets very far stretched away from its 50 and especially 200-week moving average to the downside, you see big selling spikes culminating that are way larger than anything you've normally seen on the chart, and that ABC has come way down. And then more importantly than all of that, the price to earnings multiples, the PE ratios, have compressed down from a PE of 20 something here to probably a PE of like 6 or 8 or 10 down in here. These are all signs that you're starting to get in an area of value, or these are signs that you're in an area of overvaluation when the PE was at 24, 25, 26, and down here you get into very deep. And a price to earnings ratio, you can Google that. That's just simply a way of measuring an index's price. In this case, a stock or an index, but we're analyzing an index right now. An index is price, average price, relative to an index's average earnings. And the price can only go so far from its ability to put out earnings. So, for instance, it would be dumb for me to pay $100 million for a pizza place that put out $1 million a year in earnings. So, that'd be a PE of 100. So why would I want to have to go 100 years of earnings before I get my money back and break even? Yet, if I could buy a pizza place that did a pizza chain that did $1 million in earnings, yet I bought it for $2 million, then in 2 years of earnings, I've got my money back, and then it's all gravy from there on out. So, I know you have other costs, but your initial investment money is back out of it. So that'd be like a PE of 2. So, you generally won't see PEs of 2s on major indexes. You might see 6 or 8 or 10, and you generally won't see a PE of 100 on a major index, but you might see, 20, 25, 26. And so it's a way that you can fundamentally evaluate risks and overvaluation and undervaluation, which is why I love that metric so much. And it's no respecter of persons. It doesn't get emotional. It doesn't get biased. It doesn't hear the news. It doesn't care about any of those types of things that are big distractions. So we're 5 waves up again in this one of the longest uptrends in U.S. history. 1, 2, 3, 4, 5, and we don't know if we've hit the top of wave 5 yet, but we do know that with these huge divergences, there's a good chance that we have, and if we haven't, then it's just a ticking time bomb. You get another rally, and then it starts if it hadn't started already. And these sharp rallies higher that we've been seeing are usually indicative of bear markets, because usually bear markets have sharper rallies up within them than a traditional bull market does. Bear market is simply a market that goes downward versus bull market, one going upward. So there's many different ways that we can tell that the price is very extended. Look at how far the price was from the 200-week moving average there. Look at how high we got here from this one, much further. And there were divergences on the RSI and MACD that set up that warned ahead of time that this was coming, and we've got this again here showing. And sometimes you get divergences on some of the smaller waves as well, but when you're 5 waves up, that's the end of an uptrend. So we know somewhere up here, whether it's one more push higher or whether we've seen it right here, we're nearing the end of that, and then it's heading lower. So just on the S&P 500, let me give you some levels to be aware of. Again, you want to look this 2940-ish, 2940, 2941, right in there. You want to see if there's a bounce back, if it surpasses those highs. Another area is to see if it continues to hold below the 200-day moving average. And then if it fails at these levels and starts to head lower, then we go back to that box that I was talking about, the 2530s to 2600-ish area. If it clears there, then we are making major lows that are lower than what we see here, and that will constitute us being in a bear market, because by that time we'll have made likely lower highs and lower lows. So those are some areas to keep an eye on. But there's a lot of technical warnings out there, from the high selling volume, the breakdown in RSI and MACD on both the daily and weekly charts. We're starting to see a bit of an arc over here on the 50-day. On the weekly chart, there's still a big gap. Even as much as this has fallen so far, there's still a huge gap between here and the 200-week moving average. And when you do finally get to the end of 5 waves up, which there was 5 waves up that preceded this, you just can't see it on the chart. Then you have 3 long waves down, which go far below the 200-week moving average. Finally, then in a regular uptrend, the 200-week tends to hold that region, but when it breaks it and goes way below it is when at the end of that 5 waves up rally. And so we're in that period now. So when it does break it, it's going to go well below this area. How far below, nobody knows for sure, but I can tell you they always go a lot further than you would ever think that they would. So with that said, you can use previous resistance levels and previous support levels to give you a good idea. So we know they go well below the 200-week moving average, and here is a level of previous support, and here is a region of previous resistance. which becomes future support. So anywhere in this box is the most likely area. So can you imagine the S&P 500 going from 2940, almost 2941, down to the 14 to 1900 area? And people may say, well, that just sounds so far-fetched. And to that I would say, let history be your guide. And let me just take you back to the last two crashes let me go back where it gets it all on the chart. So we're going to look at the crashes of 2000 and 2008. So the S&P 500 went from 1553 to 768. So enormous. I think it was like 40-something percent, close to 50% retracement before that ever turned around, hit bottom, and look, it went way below its 200-week moving average and had its ABC downtrend. Then you have 5 waves up once again. And so after that happens, you have another 3-wave downtrend, ABC here, goes way below the 200-week moving average before finally turning around. And again, you start to get in some very heavy volume, selling volume when you're getting in the latter stages of the downtrend. A lot of volatility on towards the end of the downtrend, a lot of volatility towards the top of the uptrend. And so we're experiencing the ton of volatility here lately, here and here. And so we know that we're getting closer to that downturn if we're not even in the early stages of it now. And then, one other thing that'll show that we are, and this will be a later confirmation, of course. I talked about the earlier confirmations, but when this uptrend line is broken, which will be pretty much coinciding with when the 200-week moving average is broken, that's another way we'll know that we're in the downtrend. So in this one, it would have looked something like this. So in this one, the line breaks a little earlier before the 200-week and then unfolds. So it breaks the trend lines, it breaks the moving averages, and continues on for quite a while. So we've broken this one, and again, short term, it could regain it up above it. Not saying it won't, but then I'm looking for it to head down and retest this 200-week moving average and this trend line. And then when it breaks it, it's going to go significantly below it. How far significantly, literally only God knows. But we do know from history and watching previous crashes that there's a lot of panic that has to ensue. There's a lot of despair and fear that has to happen in markets before a downtrend comes to an end. And so extreme price moves have to happen before all that transpires. We do know that. And this downtrend, it went from 1576 to 666. This one, 1553 to 768. So you can see when I say it going from 2940 to 1900 or even 1400, that is not far-fetched, by any stretch. If I had to make a guess, I'd say it would easily, high probability of it being anywhere between 16 and 1900 for sure, would be my best guess, but it could go, that much lower. So those are some things to keep an eye on, and all the other indices look the same way. The Dow is sometimes more tracked by a lot of people than the S&P 500, even though the Dow only comprises 30 stocks versus the S&P 500 being 500 stocks. But you got the same thing here. The Dow, it's breaking below a major aggressive uptrend line that's lasted over the last 2 or 3 years. The price is dealing with its 50-week moving average right now. It's a mile away from its 200-week moving average. You got your negative divergence where this went higher. These highs went higher. The RSI went lower. The very sharp start sell signal on the MACD and divergence there. Some sell spikes starting to creep up. So here's your 1, 2, 3, 4, 5 waves up, and we're getting ready for our 3-wave downtrend. So the last time on the Dow, this went from 14,198 to 664.69, and the one before that it was 11,750 down to 71.97. So when I say these things can get severe, we're talking big time severe. So again, with this one going well under its 200-week moving average, you would be looking at the probability of this going anywhere in the best guess would be somewhere in the 14 to 16,000 range. That would put it well below the 200-week moving average. And again, it could even go lower than that. I'm not saying it wouldn't or couldn't. It absolutely could. But can you imagine the decline from 27,000 just to 16,000, the very top of that range, much less 14,000 or anything below? That's a massive retracement, and that's what we're likely in for. If you'll notice, there's 5 waves up, PE valuations get high, the price gets far away from the 200-week moving average, and there's a lot of volatility at the tops and a lot of divergences that happen. That's what happens each time we get to these topping periods, and that's literally what we're living through now. So here's 3 of them, that one, and the one that we are, could be at the top of, but if we're not at the top of, again, we're not far from it. So, just to kind of redraw some scenarios, I'm not saying that we have to go straight down from here. This could go up to, to one more high before we to do the 3 waves, downward. It could do to where it goes up and and there's a rally that falls short of these old highs, and then it goes down, or it could already be in process and go to a lower low and then put in a lower high and then going down. So there's several scenarios that can play out, and nobody knows for sure which it'll be. But in knowing Elliott wave counts and knowing PE ratios and knowing technical divergences, which show slowing upward momentum, and seeing the volatility that happens at tops and the distance the price is away from the 200-week moving average relative to where it was in previous crashes, it all says that the markets are extremely high risk right now. And again, the average retail investor is so bullish because all they know is to look in the rearview mirror. Well, the market's gone up a lot, so hey, and the economy's been good, and employment's low, and employment is always the lowest before it starts to turn around and start to head high. You always have the most full employment before it starts to turn around and head to something much worse. So at a certain point, the most optimistic indicators actually become contrarian indicators. So, both these rallies had gone for quite some time, and people have never thought that what would have transpired did. Matter of fact, this one erased more than all the last rally combined. So this went from 71.97 to 14.198, and then it went down to 64.69 before it finally ended. So it wiped out that total bull market there. They don't always wipe out the complete 100% bull market, but in this case it did. In the previous case it did not, but it'll minimally wipe off usually, 30 to 60%, and I would say close to 40 to 60% retracements off the highs are very common in actual three wave downtrend bear markets. So spread this around, because people need to realize these dangers out there, because their 401ks are on the line, their IRAs are on the line. Is there some slight chance that these risks will be ignored? That it goes higher and somehow something miraculously ignores history, and it doesn't happen? Sure, there is some minute, slight chance of that happening, but that is not probable at all. What is probable is what I've seen with every asset bubble burst in history that I can find, is that same pattern of what I've told you today. And so far, I've never seen one escape it. And at the time, when you're towards the top of a bull market, things never seem better, never seem brighter. You just can't see a day where it would ever turn around. When the Dow went from 7,000, 8,000, 9,000, 10,000, 11,000, 12,000, 13,000, 14,000, 14,198, do you think that it felt like that there was a bear market that they were on the cusp of? No, it didn't. But it didn't stop it from going 14,000s to the 6,000s before it was over. So, here we've gone one of the longest bull markets in history, from 64.69 to 27,000. You think that this thing is not going to have a corresponding downtrend? The probability of that happening, of a huge downtrend happening, is huge. The leverage out there is higher. the sentiment is among some of the most bullish, which is actually a bearish indicator, and all these technical indicators and PE ratios. So fundamentally or technically or sentiment-wise, any way you look at it, the engine lights are coming on, those big red engine lights, and the retail public is not paying near enough attention. But institutions are exiting. They're not going on TV and telling you they're doing it because they need to get out of there because millions of shares first before they tell you. Can you imagine if they told you at the same time they're doing it? They wouldn't have anybody to buy their shares they're selling. So they can't do that. They have to tell you after the fact. So I'm not in the business of telling people stuff after the fact. That's why I write the newsletters, to tell you stuff ahead of time and while stuff's in process, but not after the fact. Those of you who followed me for years know that I'll give you a lot of warnings and a lot of heads up well ahead of time, so that you're prepared months to a year or two ahead of time for what will be coming. And I tell you sometimes a year or two ahead of time what analysts on TV will be telling you. So that's worth a ton. Anybody can tell you stuff in hindsight. Oh, and 2007 and 8, you should have sold houses and not bought. Oh, well, anybody can say that in hindsight. You should have sold the market up here and up here, 2000, 2008. Anybody can say that in hindsight. But when it's still elevated and somebody gives you the warning signs that are there, and I'm not saying this for sure is the top. I'm saying this is a toppy period. The valuations fundamentally are ripe for a downturn. Technically, it's stretched enough and divergences are happening enough for there to be a downturn. The big red spikes that you're seeing those are produced by institutional selling. They're getting out. So the institutions, the smart money, are making shifts. And again, it's sad because what they do is they go on TV and they rah-rah the stocks, and then they go back to their offices and hit the sell button because they need you bullish, they need you optimistic, they need you to think that things are going way, way higher because, again, when there's a seller, there needs to be a buyer. And so if institutions are selling, what are they going to do? They're going to need an avid buyer. And so there's a shift from the smart money to the dumb money. And the dumb money is the uninformed public, and their 401ks, their IRAs, their individual brokerage accounts. They're great at what they do as their day jobs, but they're ignorant when it comes to the stock market, and all they do is chase momentum, and they have no idea when it ends, and when it ends, it comes down with a fury. There's a saying in the market that the market takes the escalator or the stairs up, and it takes the elevator down. And that's because there's very little liquidity on the downside, because there's a very equal amount of both buyers and sellers on the way up, but it's almost a one-sided market on the way down. When the market's dropping like a knife and every day it seems to be going down, who do you think's wanting to go in there and buy? Non-institutions and moms and pops. They're too scared to do so. Most of the time they're fully invested and just in victim to it going all the way down anyway. So if you've been a part of these, again, I helped my dad back in the day when he was still living avoid these bear markets, and I've got a knack for keeping a level head and spotting asset bubbles and overvaluation. And we are in one right now. So again, spread this to as many people as you can, because there is an urgency to be aware of that. I'm not telling them to sell. I'm not telling them to go to cash. I'm not telling them what to do. I'm just telling you here are the warnings, and then it's up to you what you decide to do from there. Now, with my specific subscribers, I do have a portfolio. I do have specific buy and sell recommendations that I'm giving them, and the reasons why we're in them and the reasons why we're exiting them, with no stone left unturned, and in a format that the average person can understand it. But to you, I would just say here are the huge warnings. And again, if you'd like to become a subscriber to the Ultimate Wealth, to the Logical Newsletter, I'll get it out now, the Logical Investor Newsletter, you can subscribe by going to SeanHyman.com, SeanHyman.com, and you can go to the Premium Newsletter tab, click on Premium Newsletters, scroll down on any article, so click on that title of any video or newsletter, and scroll to the bottom, you'll see a sign-up button. Click on that, and for $97 a year, you can get 12 monthly issues, buy and sell recommendations, and weekly videos that come out by every Thursday evening as well. all for, what is that, $8 and something a month. So very reasonable. I try to keep it cost low so that I can reach and help as many people as possible. And so it's not an overly burdensome price for you to get quality advice. Okay, thanks so much for watching, and God bless. Bye-bye.